Welcome to the deep dive. Today we're digging deep into the latest numbers from a major player in data storage, Fiscal Q1 2026.
That's right. We've got the earnings report, the supplemental data, lots to unpack.
And our mission, as always, is to figure out what's really going on behind the headlines.
Exactly. How do they hit these record profit levels? And, what does it tell us about the impact of AI?
Because the overall message seems pretty clear, right? Strong execution, expanding profits, revenue up 21% year on year is solid.
It is solid. But the number that really jumped out at me, the big one, is that non-GAAP gross margin.
40.1%. That's huge for this kind of business.
It's a record for them. And that's the thread we need to pull on. It connects directly to their new HAMR tech, the Mozaic drives.
Yeah, and the demand coming from the data center. Especially cloud and AI, I assume.
Precisely. That's where the action is.
Okay, so let's get into those hard numbers. Q1 fiscal 26 non-GAAP, you mentioned revenue, $2.63 billion.
Yep, $2.63 billion, which is up 8% from the previous quarter, and like you said, 21% year over year. Good growth.
But growth isn't the whole story here, is it? It's the profitability on that growth.
Exactly. That's the core of it. That 40.1% gross margin, think about the increase. It's up about 220 basis points just from Q4.
2.2 percentage points in one quarter.
Yeah. And compared to last year, up 680 basis points.
Wow. Nearly 7 percentage points higher year over year. That suggests something fundamental changed. What are they saying caused that?
Well, they point to two main things. First, customers are buying more of their latest gen products, think the higher capacity, higher value drives.
Makes sense. Selling the premium stuff.
Right. And second, they mention ongoing pricing actions. So basically, they're getting better prices for their products too.
And that profitability, it flowed down the income statement.
Oh, absolutely. Operating margin, non-GAAP again, hit 29.0%. That's up significantly, about 860 basis points year over year.
Which leads to earnings per share.
$2.61, diluted. And that beat the high end of their own guidance range. So they outperformed expectations.
Okay, strong performance, beating guidance. And you see that confidence reflected in cash flow too, right?
Definitely. Cash flow from operations was $532 million. Pretty healthy.
Leading to free cash flow of
$427 million. Good conversion.
And when companies generate that kind of cash, they often return some to shareholders.
They did. They actually increased the quarterly dividend. Just slightly, about 3%, up to $1.74 per share.
It's not a huge jump, but increasing a dividend signals management is pretty confident about the future, doesn't it?
It absolutely does. You don't raise the payout unless you feel good about sustained earnings and cash flow down the road.
So where is that confidence coming from? Which markets are driving this? You hinted at it earlier.
Yeah, it's all about the data center. Overwhelmingly so.
Okay, give us the specifics.
Data center revenues surged 34% year over year. It hit $2.1 billion for the quarter.
Hold on, $2.1 billion out of $2.63 billion total.
Yep, do the math.
That's 80%. 80% of their total revenue is now coming from the data center segment.
80%. And check this out, a year ago, in Q1 fiscal 25, it was 73%.
Like that concentration is actually increasing 7 percentage points in 1 year. Isn't that risky? Relying so heavily on one segment.
It's a fair question. Concentration always carries risk. But the context here is important. They emphasize that they're nearline production.
Remind us what nearline means again?
Sure. Nearline basically refers to those super high capacity hard drives designed for large-scale data center storage. Not necessarily the absolute fastest access, but massive capacity. Think cloud storage, backups, archives, that sort of thing.
Got it. So they're nearline production.
It's largely committed through the calendar year 2026. These aren't just speculative builds. They're based on build-to-order contracts with major customers.
Ah, okay. So yes, it's concentrated, but it's also highly visible, predictable revenue for the next, year and a half or so?
Exactly. That visibility mitigates some of that concentration risk. You can see the sheer volume in the capacity numbers, too.
Right. How much total capacity did they ship?
Total hard disk drive capacity shipped was 182 exabytes. That's up 32% year over year. Massive numbers.
182 exabytes. And how much of that was nearline for the data centers?
159 exabytes, so the vast majority. And that nearline segment grew even faster, up 39% year over year.
So data centers aren't just buying more storage, they're buying proportionally more of the highest capacity stuff?
Precisely. And look at the average capacity per drive.
Yeah, I saw that metric, 14.6 terabytes.
Right, which is up 13% just from the previous quarter.
13% quarter-over-quarter jump in average drive size. That tells you customers are rapidly shifting to denser drives. They want more storage in the same physical rack space.
Absolutely. Fewer drives, Less power, less cooling per terabyte. It's all about total cost of ownership, or TCO, for these big cloud players.
And this insatiable appetite for dense storage. Let's connect the dots. It's AI, isn't it?
It's fundamentally fueled by AI. The sources are pretty explicit about this.
How so? We usually think of AI needing fast GPUs for processing. How does that drive demand for, comparatively slower spinning hard drives?
It's because AI models need data constantly.
Yeah.
Huge amounts of it. The report mentions AI inferencing specifically.
Okay.
So the GPUs do the inferencing, the thinking. But to do that effectively and to keep improving, the models need constant access to vast data sets to store the inputs, monitor the outputs, validate results, and then feed that back into the training loops.
Ah, I see. So the hard drives aren't just for cold storage anymore. They're part of the active workflow. Storing the data that grounds the AI, validates it, helps refine it over time.
Exactly. It's an infinite loop. Store, process, validate, reintegrate, retrain. And that requires enormous accessible capacity. These nearline drives are critical infrastructure for that loop.
Okay, that makes a lot of sense. And the technology enabling this density, allowing them to pack more data onto each disk, is this Mozaic platform using HAMR.
That's the key enabler. Mozaic is their brand name for drives using heat-assisted magnetic recording, or HMRU.
Explain HAMR quickly. How does it work?
Okay, super simplified. Traditional magnetic recording has limits on how small you can make the magnetic bits on the disk platter before they become unstable. HAMR uses a tiny laser, part of the right head, to briefly heat a microscopic spot on the disk.
Just for a moment.
Just for an instant, yeah. That heating makes the material temporarily easier to magnetize, allowing them to write much smaller, more stable bits very close together.
So, laser heating equals denser data storage.
Basically, yes.
Yeah.
Significantly denser. And that density is what allows for these massive drive capacities, which in turn drives those higher margins we talked about.
Right.
This isn't just an R&D project anymore either.
Right, you mentioned shipments.
Over 1 million Mozaic HAMR drives shipped in the September quarter alone. That's volume production.
1 million units. That's substantial. And are customers actually deploying them? Qualification can be a hurdle.
That's the crucial step. And they said these drives, the current Mozaic 3+ generation, are already qualified with 5 of the world's biggest cloud customers.
5 of the hyperscalers already on board? That's huge.
It is. Qualification is everything. Once a drive is qualified, especially by a major CSP, it tends to lead to large, long-term orders. They even gave an example.
Oh, yeah.
Dropbox. They specifically qualified the 32 terabyte Mozaic drives. And Dropbox noted how it boosts their AI scalability and, interestingly, sustainability.
Sustainability. How so?
Higher density means fewer drives needed for the same amount of storage. Fewer drives mean less physical hardware, lower power consumption per terabyte, less cooling needed.
Yeah.
It all adds up to a greener footprint.
Right, that TCO argument, again, lower operational costs and better environmental profile. Makes sense. So 5 major CSPs qualified. Are they working on the rest?
Yep. They said qualification with the remaining few major global CSPs is on track for the middle of calendar year 2026.
Okay. But technology never stands still. Are they already looking beyond this Mozaic 3+ generation?
Absolutely. They're already talking about Mozaic 4+ variants, apparently already in qualification with a second global CSP.
Already qualifying the next generation. Wow. When do they expect to start shipping those?
Initial volume ramp is slated for the second half of fiscal year 2026. So not that far away, really, within the next year or so.
And what kind of capacity loop are we talking about with Mozaic 4+ mean?
This is where it gets pretty wild. They're saying this platform will support capacities up to 44 terabytes on a single drive.
44 terabytes? Good grief. That's just staggering density, almost double the current high end.
It really is. Think about what that enables for cloud data center buildouts. It's essential for keeping pace with data growth.
Unbelievable. But I noticed something else they mentioned about Mozaic 4+ Dean. It wasn't just about the massive 44 TB drives, was it?
No, and this is interesting. They explicitly said the platform will also support lower capacity drives designed for, quote, edge workloads.
Edge workloads. Okay, so not just the giant hyperscale data centers, but potentially smaller deployments closer to where data is generated or consumed?
That seems to be the implication. It suggests they're thinking beyond just feeding the cloud giants, maybe looking at diversifying into storage for autonomous vehicles, smart factories, edge AI inference, places where you need decent capacity locally.
Interesting strategic signal there. We should come back to that. But first, let's circle back to the financials, specifically the balance sheet. How's their overall financial health looking?
Pretty good, actually. The strong profitability is definitely helping de-risk the company financially.
How so? Debt levels.
Yeah, total debt is around $5.0 billion, but their net debt, which is total debt minus cash, has come down quite a bit. It was almost $4.5 billion a year ago. Now it's down to about $3.93 billion.
So they're paying down debt or building up cash faster than debt.
Both, looks like.
Uh,
But the really telling metric is the leverage ratio.
Total debt to EBITDA, usually.
Right. Their total leverage ratio improved dramatically. A year ago it was 3.2 times. Now it's down to 1.5 times.
Wow, cut in half in a year. It's a much healthier, much less risky profile. Investors probably like seeing that.
Oh, definitely. And they still have plenty of liquidity. About $2.4 billion total between cash on hand and their revolving credit facility. So they have flexibility.
I did see a footnote about some debt being reclassified. Something about exchangeable senior notes. What was that about?
Ah, yeah, the $1.5 billion notes due in 2028. They got reclassified to the current portion of long-term debt.
Meaning?
It means a conditional conversion option was triggered. Usually this happens if the company's stock price stays above a certain level for a period. It doesn't mean the debt is being converted right now, but it means the option for investors to convert it into stock under certain conditions is now active.
So it's more of an accounting flag reflecting a potential future equity conversion rather than an immediate cash crunch.
Exactly. It's something accountants and analysts track. It reflects the possibility of dilution down the line. But given their liquidity, it's not an immediate solvency issue, more of a technical change based on the terms of the debt and the stock performance.
Okay, got it. So strong underlying financial health improvement. Finally, what about the outlook? What guidance did they give for the next quarter, Q2 fiscal 26?
They're guiding for continued strength. Revenue expected around $2.70 billion, plus or minus $100 million. So potentially another sequential increase.
And earnings.
Non-GAAP diluted EPS guidance is $2.75, plus or minus 0.20 cents. Again, pointing towards continued high profitability.
And they noted this includes assumptions about taxes and tariffs.
Yeah, they factored in the estimated impact of the Pillar 2 global minimum tax framework and assume, as of late October 2025, minimal direct impact from announced global tariff policies. Basically, they're signaling confidence that the HAMR transition and the AI demand cycle will keep driving results.
Okay, so let's try and wrap this up. If you had to summarize the story from these Q1 results.
It's a story of technological execution meeting market demand. They successfully ramped their next-gen HAMR technology, these Mozaic drives.
Which deliver unprecedented density.
Exactly. And that density is precisely what the massive cloud providers need to cope with the daily explosion driven in large part by AI.
And that combination premium tech plus huge demand is what drove those record gross margins, the improved leverage, the increased dividend. It all ties together.
Perfectly. The data center, fueled by AI, is locked into buying these high-capacity drives, probably well into 2026 based on their contracts. They need that 44 TB capability that Mozaic 4 Plus promises.
It paints a picture of a company really firing on all cylinders within its core market.
For sure. The execution on the Mozaic ramp seems impressive.
But you brought up that interesting point about the Mozaic 4 Plus platform. It's not just for 44 TB cloud drives.
Right. They specifically mentioned it also supports lower capacity drives for edge workloads.
So here's the thought to leave our listeners with. We see the clear demand from the hyperscale cloud for maximum density. But what does this explicit mention of edge capability signify? Is this the start of a broader strategy shift? How significant will that edge market become for high-density storage? And how quickly might technologies like HAMR penetrate beyond the massive data center into more distributed environments?
That's the question, isn't it? Is the future purely centralized massive clouds? Or is there a growing role for powerful storage closer to the edge? And how does that reshape the infrastructure market?
Something to watch as this technology continues to roll out.